Episode 593 of the Trading Justice podcast, joined with my brother Matt Justice. This is Mark, two Fed geeks, two macro geeks that get to discuss a Fed pivot. So obviously we are drowning in nerdy euphoria this weekend, analyzing what that means moving forward. We'll break down the pivot that occurred at Jackson Hole on Friday. Talk about what it means for markets. We're going to talk about exactly what happened, what it means for markets, and then analyze some of the history of when the Fed has pivoted before. The data is very, very interesting, very compelling. My brother Matt did a great job on the newsletter for Tackle Trading this weekend, breaking down that historical data. We'll share that with you. And then in the midst of all of this macro, we're going to, at the end of the podcast, talk about a little company called Nvidia who happens to have earnings this weekend. So that is our agenda today. Matt, now that I have laid out that agenda in a nice, concise manner, how are you doing?
Doing good. Excited to be here. And as always in the pod, we'd like to talk about the week that was and also have a conversation about the week that's coming at us, making sure our community is fully apprised of the economic and earnings and, you know, the landmines out there from a market perspective so that they're aware of everything. And obviously coming into this week, it was all about Jackson Hole. As you leave Jackson Hole, there's the Fed's going to be coming. Don't get me wrong, it's still a very important conversation, but it's not going to be as much in terms of the sensitivity to everything the Fed says and does because, quite frankly, there's a 100% probability of a rate cut starting in September, and Jerome Powell confirmed that at Jackson Hole. So it's going to be a really, really interesting economic environment. Certainly we'll have a discussion on that. But for this week, it's all about Nvidia. You know, it's amazing. You spend so much time trying to understand the landscape, the macro, the monetary, the fiscal, the geopolitical, and you move on and you're like, it all rests on Nvidia's shoulders.
Yeah, no, listen, and before we get diving into the details, did you spend more time this weekend as a Miami Dolphin fan analyzing Tua's comments about his previous head coach or about Jay Powell's comments? Be honest with your audience. They'll know if you're lying.
I am fully aware of Tua's commentary towards the former Miami Dolphin head coach. Yes, I am aware of those comments, and all I will say is I've heard both sides of the equation, and as somebody who's a little familiar watching Tua from his rookie season on, he was played dirty in the first year at Miami, quite frankly. And Mike McDaniel came in and did a great job. And in Mike McDaniel, I trust as a Miami Dolphin fan. I'll tell you that right now. So I think coaches try to coach, and sometimes you try to find the right message. And so I don't hold in. I wouldn't say anything negative about the former Miami Dolphin coach, but. In terms of coaching, Mark, you've coached, I've coached sports, I've coached in a lot of different capacities. We coach at Tackle Trading people how to trade and invest, and sometimes you have to have difficult conversations with your students, and Tua had to have some difficult conversations along the way. But at the end of the day, as a coach, you try to build. And I don't think Tua had that part of the coaching in his rookie season. So obviously I spent some time thinking about that one. But I'll say Jay Powell, I spent all Friday, Saturday, and the big bulk of Sunday thinking about Jay Powell and what the pivot means. Because, honestly, Mark, before we get into it, out there on social media and out there in the financial media and whatnot, it's almost like the market has declared victory here. I saw a lot of people that have very, very large social media followings going out there like, "Oh, free money again, guys! Free money again."
The amount of
and I just find I want to be clear on this because I find it to be not only extremely lazy analysis. I find it to be harmful analysis to their followers. And so I wanted to make sure that we are crystal clear in our tackle trading community exactly what, we did a great job, Mark, getting our community to understand the increasing of the rate conversation. We did a great job getting our community to understand what the pausing impact is. And now I think it's our turn to get our community ready for what exactly a rate cutting cycle is. Because I can tell you one thing it's not It's not rip your face off bullish. That is not what the data suggests historically. That's not what a rate cutting cycle is all about. And I think social media and the financial media is doing a disservice to the market participants by just assuming this is just automatically bullish.
No, I mean, the thing about it is, you're a more avid social media totality, understand
the hot takes on social media are absolutely ridiculous.
But
absolutely.
I do like my message boards to try to get a pulse of that. And I saw the same thing, Matt. I saw the money printer, Jay Powell,
money go burr,
and all that. And we're back. Like, oh, this is 2020 all over again with a supportive Fed. And well, it's not apples and apples.
The ultimate question is this 1995-96 or is this 2001 through 2003? That doesn't make
that does not make as easy of hot takes on social media, but that's what we're going to give you today.
But that's the real conversation, and that's important. So obviously we're going to be talking about Powell pivoting and what it all means. Where do you want to go?
Yeah, well, let's start with what happened on Friday. Now, I'm going to give you my big take. Let's go over the specific things. There's a lot to break down. Matt, Jay Powell was without a doubt more dovish than I anticipated. He came across as a very dovish message. He didn't make any bones about the tone he had. Yeah. Right. He obviously wanted to be very, very clear. Right. And a lot of us have had criticisms of Jay Powell in the past that he is ambiguous, right? Doesn't want to. He came out and he had a tone, he had a message. He wanted to deliver that along with, and this is why we screwed up last time. But we'll talk about that here in a little.
There was a little bit of mea culpa there. There was some storytelling with some beer goggles on, I would say there, Jay Powell.
But first and foremost, he said the time has come, right? He used language that made it very clear to all market participants that a rate cut cycle was underway. He did not specifically say we're cutting in September. He didn't need to. He said the cycle cutting has begun, and that then leaves the market to interpret, well, how many cuts are there coming? How many, but he no bones about it. Mm-hmm. And what I found very interesting, Matt, is the Fed can choose whoever they want to speak after Jay Powell speaks, right? It is very normal on Jackson Hole Day to flood the airwaves with Fed speakers. Mm-hmm. They chose Harkin and Goolsbee to do that, both of which had a very clear, we're cutting and we're not stopping until we reach the level that we feel is appropriate. The totality of the messaging, Matt, pivot is here. The rate cut cycle has begun, and it will continue until they reach a point where they feel that either they've done enough or something forces them to stop their hand. Is that the same general message you got as well?
Yeah, I would say that's the same general message I got there, Mark. And first and foremost, I've been very critical of Jay Powell over the years. And what I'm about to say doesn't change my overall opinion. I think he has not been as transparent with the market as he needed to be. And I feel like he's made some historical mistakes that delayed our recovery, quite frankly. But I want to also say it's been historically a difficult job in the last 6 years as the central bank president as well. We're talking about some of the more difficult economic environments we've had to deal with, even including the subprime meltdown that goes all the way back to the late 1970s. And quite frankly, the reason we all look at Volcker as the number one central bank president of all time is how he handled the difficult times between the late 1970s and the early to mid 80s until Alan Greenspan took over in 1986. But you look at the last 6 years, and again, I don't want to spend this time talking about all his mistakes. We've kind of detailed that along the way, but I want to give him some credit here. I thought he gave a good speech.
I thought he gave a good speech too.
I thought he gave a good speech. I thought he was concise. I thought he was transparent. Do I think he was, trying to paint the transitory language in a way of, trying to get people to not put that on his tombstone? I think he tried to paint it with a little bit of rosy-colored glasses on, but And I think we all do that. I think that's human nature to try to provide the context in your decision making. And so I had no problem with him going through and providing that type of information in terms of how he saw the transitory, what they were doing, why they made the decisions they did. And then he comes into what they're going to be doing now. And Mark, my biggest criticism on Jay Powell and the Fed is not regarding what they have done from a cutting or a pausing cycle or whatever the case might, or a raising cycle. It's on the transparency and the language that he has used in the messaging to the market, where he has been trying to paint this both sides of the equation for so long that it was very difficult to get an understanding exactly where the Fed is at on their dual mandate. Very data dependent, dependent on all sides of the angle, inflationary data, economic data, you name it. And it was difficult to parse that data. So coming out of Powell, I thought he was transparent. I thought he gave a good speech, quick, concise, to the point, and that's exactly what you want to be in these types of moments when you are making decisions to adjust policy. And there is no debate. The path is clear. They're starting in September. The question is the pacing. And that's what's really going to
and I want to get to that in a second on that pacing conversation. But one thing, because you and I watched the speech together, and one thing that we both picked up on immediately, if there was one subject outside, if you take away his little journey about transitory and why that occurred, if you take that little history lesson in which he was obviously trying to spin his own legacy, that's what, and fair enough, he got to the pulpit. Yeah. Try to spin it. You're not getting away from that. You're going to own that.
Doesn't matter what you say. Very important data points in the bump up in inflation in 2020 and 2021.
Outside of that little monologue at that point, the single subject he focused the most on was labor. Mm-hmm. There was a particular emphasis on the weakening of the labor market. I think at one point he used a phrase, the labor market has unmistakably weakened, right? He used that word, unmistakably, like can be no room for debate. And then it was very, very, very clear. And this is one of the things that I thought was one of the real strengths in a really good speech overall, that the Fed was not going to tolerate further weakening of labor. Like they had said, this is the line in the sand. Because there have been times in the last couple of years where they have welcomed weakening in the labor market, mm-hmm. right? They've been very open about that. And they said, nope, no longer. We are going to openly tried to support the labor market, which was obviously extremely dovish in its tones. Your thoughts on the labor market comments?
The mandate so far, again, the central bank has a dual mandate, obviously inflation and the economy, right? So price stability and then you have labor, basically, is a dual mandate. The mandate during the pausing cycle, which has been about the last year in the market, has been dual, which means they were equally sensitive to the inflationary data versus the labor market data. And what they wanted to see, and they were very clear on this, quite frankly, is they wanted to see labor give up a little bit of their gains. And by labor giving up a little bit of their gains, well, that's going to bring down inflation. And mission accomplished, should we say, on that front. We have seen the labor market give up a little bit over the course of the last little bit. And as you can see, look at 2024, like during the actual pausing cycle. Okay, so we're going to just focus on the data during the actual pausing cycle. The pausing cycle has been right around the last year. So as you can see, and for those of you listening, I'm looking at a graph of the unemployment report over the last year. And we've went from 3.6 to 4.3 over the last year. That's giving up a little bit on the labor front. The Fed wanted to target labor, and by targeting labor, they were basically targeting inflation, saying, I want to see some weakness in labor data. And weakness in labor data is going to help us bring down that inflationary conversation. And rightly so. What have we seen in the last year during the pausing cycle? We've seen labor unemployment rate go up, meaning the economy is giving up a little bit of their gains. And what have we seen on the inflationary side? We've went from 9% year-over-year inflations to around 2.93% year-over-year inflation. And so the Fed looks at that data and they're saying, okay, we have achieved what we wanted to do. We wanted to give up a little bit of the labor to get greater confidence on the path down to 2% from an inflationary perspective. And so the Fed looks at the data here and they're saying, okay, we could go further than this. We could give up a little bit more on labor, but Mark, there comes a point in time where if you try to give up a little bit too much on the economy, it breaks and it rolls over. And once it breaks and it rolls over, it's really, really, really difficult to stop that. And so they're trying to get in front of that economic conversation, and that's what they did. And that's what Powell did basically, Mark, when he was talking about the adjustment on the policy. He was talking about the risk assessment has shifted. The risk assessment was equal in terms of the inflationary concern versus the labor market concern or the economy itself. Well, now that has shifted the balance of how we see the risk, i.e. Jay Powell and the central bank. They see it from a economic labor perspective more so than the inflationary side of the equation. And in essence, what that does is it declares victory on inflation. And I know politically, everybody and their dog's having an inflationary conversation. Who's to blame? Who's going to get some credit? Who's to blame? Who's to blame? Who's to blame? That conversation is going to happen politically, Mark. But I just want to be very clear. That conversation is going to happen politically, but from a central bank who really is the entity that controls this conversation, they have declared victory on inflation. Whether consumers want to hear that or not, I'm not sure. Whether that's great for our society, I think we're going to have to see the data down the road. But they have declared victory on inflation because now the balance of risk is shifted to now the labor side of the equation. And because that risk assessment has now shifted to labor, that's where you kind of bring into the conversation. Well, now we got to be laser focused on labor. And so that's where the conversation now kind of goes, is it goes from inflation. Now let's talk about PMI numbers. Now let's talk about GDP numbers. Now let's be laser focused on labor market numbers, because this is an economic conversation. As during cutting cycles, it is purely an economic conversation. It's not necessarily about inflation any longer.
Yeah, no, and that mission accomplished, Phil. Matt, there is no way Jay Powell goes on a 4 or 5 minute rant through history talking about why they got it wrong if they didn't feel that this was already beaten now. It was a very much inflation is in the rearview mirror.
Well, let me ask you a question on that. If you're Powell and you're looking at this entire environment, after the announcement of the revision of the 818,000 jobs over the last year, something that market participants are extremely familiar with, but you know who's not, Mark? Consumers. And that's a scary number for consumers. And when consumers get scared about the economy, they pull back a little bit. Small business owners, that's kind of a scary number for small business owners as well. So that was one of the largest revisions we've ever seen on the labor side of the equation, not giving up because they were never existed in the first place, but that 818,000 jobs, I mean, that takes again, that's already in the labor market data itself, but it's got to be a little bit concerning on that side of the equation. So if you're Powell and you're looking at the labor market going from 3.6 to 4.3, and you're looking at that revision on the labor of 818,000 jobs, and we see inflation go from 9% down to 3% in the last year, would you say Powell is making the right decision right now to have the risk assessment fall on the labor side versus the inflationary side?
Yes, I would.
Complicated conversation. It's not
easy. It is, because it is
yeah.
not black and white.
No,
because there are forces that could bring inflation back into the forefront in 2025.
And there's forces that could see labor implode. So, conversation.
Let's give credit where credit's due, like in the difficulty. And you already said this. This is not a easy job.
This ain't 2016, bro.
Yeah, I mean, this is not let's just hover down. No, this is, but I do feel like, you are never going to be in a perfect situation where inflation is completely under control and the economic troubles are going to be completely under control. During this whole cycle, there is going to be a balance of those risks.
There's always a rock and a hard place somewhere here.
Yeah, and so you get back to the coaching analogy, right? Mm-hmm. Like, with Brian Flores and Tua, right? Like if you read
the former Miami Dolphin coach.
yes, the former Miami Dolphin coach, where the guy's trying to coach. We talked about that started the podcast a little bit. But like you read central bank memoirs, part of what central bank leaders feel their job is to be a coach for the citizenry, to deliver a message that is encouraging. And so, like, I think this was the right message, and I think it was the right tone. Now, do I think that it is as cut and dry as inflation's been and it's never coming back? No, but there is a balance of risk, and there is problems in the labor market. Probably more problems than we even know
but
about.
do you agree with the Fed shifting their balance of risk to the labor side?
Yes, I do.
With the 818,000, I'm still concerned about inflation because there's scenarios where we see double-dip inflation.
And I think Jay Powell, I hope at least that he would acknowledge that he's not going to end that speech, but we're going to keep one eye on inflation. That would be the wrong message, But
that's the same thing as we already have. We just get one cut,
I hope we are keeping one eye on inflation down the road.
I think it's a difficult decision out of Powell, but I think he made the right one to focus on it now, because if you take it's the same conversation that happens back in transitory. If you take that concern too far to where you feel confident that the data is coming in where you want, the other side of the equation is going to take the reins and run with it. And when the balance of risk in 2020 and 2021 was to the economy. And so they were discounting inflationary data that was obvious to a lot of people, including us in the Trading Justice podcast in that moment when we were basically pounding on the table, raise interest rates. You got to do it. Inflation's becoming a concern. But back then, the balance of risk in the Fed's eyes was on the labor side of the equation. And that's where the transitory problem came in, was they were laser focused on labor and they were laser focused on the economy and post-pandemic analysis that through their own vanity, they just simply thought that the supply chain getting healed over time was going to bring down the inflationary side of the equation. That was a really, really bad bet that had a massively negative impact on millions and millions and millions and millions of Americans. But I don't want to say it was an easy choice back then, and I certainly don't want to say it's an easy choice right now. But even though I disagreed very, very, very strongly on the transitory side, I thought they were a year late in the increasing of the rate cutting cycle. I think their timing's pretty good here, quite frankly. I didn't feel it was good enough to start cutting earlier in the year. I was concerned on the inflationary side of the equation, much like the central bank. I would still say I'm more concerned on the inflationary side than the central bank. But when the data's in front of you right now that, again, this is all about their confidence in the path to getting it to a certain level. Are they confident in the path of inflation to go from 3% down to 2% over the next year? Well, if they're concerned about the economy, that might take care of it in and of itself. And so if they overshoot, they might have the biggest disaster in the world coming in with the labor side. So you can't overshoot. You got to get in front of these things. And right or wrong, Jay Powell's getting in front of the labor side. And after that 818,000 revision out of the labor market last week, I felt this was the time necessary to shift the risk to the labor over the inflationary side. But again, I still have concern on inflation. I don't think I'm never not going to have concern on inflation, though. I think concern on inflation is going to be with us for decades.
Yeah, no, and now the debate now goes to how many cuts, like this quote that we have up on the screen.
This is so cute for all you Fed watchers out there in the world. All right, let's debate it. I know the answer, but let's debate it.
The direction of the travel is clear, right? We're cutting, is what he's saying there. We're cutting. The timing and pace of rate cuts, like how many and how fast, will depend on data, blah, 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 right? The data dependent. And so, here we come, and this is going to be the debate of market participants. Matt, it's not as interesting of debate to me, maybe, as to others, because most importantly, it's like we're getting cuts, right? And as long as, and this is what something Harkin said afterwards. He was like, now that we've started cutting, basically he said we should keep cutting, that there shouldn't be a put give you a cut and then let's see. No, we should keep cutting as long as that maintains the message, right? That we are going to cut and we're going to give a rate cut every meeting until we have reason not to. As long as that remains the meeting, it's not that's the only thing I care about personally. What about you?
Well, I think if the Fed wants to be transparent in the path here, I think a cut every meeting is too aggressive. Personally, I think that. I mean, if you're going to cut every meeting by, let's say, 25, you're done in the cutting cycle in half a year from now, because they're not bringing it outside of restrictive territory.
No, they are not. That is for sure.
Happen. And so the only thing, and let's be crystal clear on this, unless an economic implosion happens, we're talking about the alleviation of the restrictive territory of the inflationary side of the equation. And when you talk about that, you're currently at 5 to 5.25. That brings you down to 3.5 to 3.75. That's a 150 basis point cut. I think the path is going to be I think the path should be very, very, very clear in my estimation. And in my estimation, if the central bank called me up and said, you know what, Matt, why don't you come in, talk to us about what the path should be, I would say you start the cutting cycle with a 50 basis point cut in September, and then you basically cut every other meeting 0.25 unless the data suggests.
I would be fine with them. That would be consistent.
That also brings you down 150 basis points from September of this year to September of next year, which means over the next year, you basically alleviate the restrictive territory to where you now have normalized the interest rate environment in 1 year's time. I think that is a far better path, and that gives you all the time in instead of 6 weeks in between meetings. That gives you 12 weeks in between meetings. That gives you a quarter of data to really get an understanding on the inflationary side, on the economic side, and quite frankly, you get those earnings. You get those earnings if you wait on 3-month time periods versus 6-week time periods. So I hope they don't cut every time, because I think it would be a mistake. I think they should try to delay this.
But do they have what it takes to communicate that clear path? Because one of the reasons this speech was more dovish for me on Friday is because just the day before, all the Fed speakers were in this slow, methodical, data-dependent type language. Like
the speed, if you go too fast, you run the risk of bubbling an environment, and I just think that would be a mistake. I also, even though the messaging out of the Fed is they've declared victory on inflation, I know there's central bank people that are still concerned of the inflationary side of the equation. So even though that messaging is kind of, the risk is shifting to the labor side, I still see there being some concern on the inflationary side. So the path and pacing, I don't know if it's that important right now. I just think if they go 50 in September and then they keep it data dependency between every meeting, it's going to create more volatility than it otherwise is needed. I think if you're clear on your messaging, clear on your path, and basically state, and this would happen in the September meeting, obviously, and basically state we are basically expecting a cut every other meeting until we have reduced the restrictive territory of the interest rate. And as we reduce the restrictive territory of the interest rate, if we see incoming data that we need to adjust that path, we will be data dependency in that. I think that's a message the market would be fine with, Mark.
The market would be fine with that message. I wonder, and maybe it's just 9 months of data dependent back and forth, seem ebb and flow with market headlines. I worry about the Fed being able to consistently deliver that message. It would be fantastic if that was the message.
I'd be a little surprised if they do deliver that message. The Fed, Jay Powell's Fed, has never been one of let me tell you what the path is. No. It's one of let me lead you to debate where the path should go. But I would say even Alan Greenspan is more accurate on the path than Jay Powell has. So we'll see what happens.
We'll
But
see.
in essence, I think the most important information is we now know that the pausing cycle is over. We're going into a cutting cycle, and we need to get prepared for that.
Yeah, and we do. And markets were very, looking at turning to markets here. Markets were, let's hold off on this beautiful historical data for 1 second. Markets were generally very in sync on Friday following the message. You saw broad gains in just about everywhere, right? You saw some overperformers leading to does this, is small caps and are going to overperform? Well, we'll see. We're going to let that one play out for a second. But you saw broad participation, to say the least, across multiple asset classes, currency, commodities, crypto, small caps, high growth. It all wanted to celebrate on Friday. Where does that leave us from a technical perspective in different areas of the market?
Well, a couple of things. Number one, the entire market, I don't want to say celebrated Powell's pivot on Friday. And again, I do think the speech was received from a positive lens for most market participants. But in the broad markets, we're not talking about breakouts here. We're not talking about momentum patterns, momentum breakouts yet. We're talking about hesitation analysis going in front of a multiple time frame perspective. And so we got pattern development this week, and that's this previous week. And I think that was really, really, really good. You don't want to see the market just go up, 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 and you don't want to see the market just go down, down, down. You want to see the market form patterns within movements. And so I think we did get that this week. We got a little bit of consolidation in the spiders. We got consolidation in the NASDAQ. You got a little bit of consolidation in those very aggressive areas of the market that are all kind of hesitating a little bit. So spiders hesitating a little bit. The Qs are hesitating a little bit. But what is not hesitating as of right now is the diamonds, the Dow Jones. It showed a little bit of breakout analysis on Friday following the central bank. So you got cyclical areas in the Dow. The Dow's very cyclical dependent, very economically sensitive names in the Dow Jones. Not exactly the ultra aggressive areas of the market, I would say. Dow looked pretty good on a multiple time frame situation. IWM obviously has a lot of work to do before we get confident in this in IWM, the small and the mid caps. But I can't see that. I can't not see that candle on Friday where you did have relative outperformance on Friday. When you're looking at the ARK index, ARK very economically, not economically sensitive, but sensitive for debt because they need debt to finance their operations. Well, they got a little bit of a bump, a little bit more of an aggressive bump on Friday. And so when you're looking at RSP, which is in general the broad market, the equal weighted index of the RSP, that broke out. You saw the Dow Jones show momentum a little bit better than
When's the last time RSP was the best looking of the major charts, right?
When was the last time?
When I don't remember the last time RSP was breaking out 4 candles into a breakout when broad markets hadn't, I guess is my point.
RSP had about a week and a half of outperformance in the last 6 months, and that's about it. And that's on the V-shape CPI report from a month and a half ago. That thing got smoked. It has never looked better against the S&P 500 than it looks right now, quite frankly.
Yeah,
this breakout is a good breakout. And you would say, well, Matt, if RSP is great, well, Dow Jones should be good, IWM should be good, ARK should be good, and I agree. I think there's context here that's important, though, and I think we need to talk about it. Number one, the message out of the Fed on Friday was dovish. Regardless of how you and I want to have the conversation, it was dovish. Would you agree?
Yep. Oh, yeah. No, that bottom line, it was dovish.
Certainly going to help all these economically sensitive areas far more than the NASDAQ. However, do you think maybe, just maybe, we saw some of the momentum in the NASDAQ hold back because we do have the most important data point of this week is Nvidia's earnings report. And so I do think there's a little bit of hesitation. Number one, a dovish Fed is going to be better for cyclical than aggressive.
You and I have maintained this for a very long time. The NASDAQ, referring to mega cap tech, is not an interest rate conversation any longer in markets. Not just now, not just 3 months from now.
Not on the index itself.
Not on the index itself, and because of the weight of Apple.
You got Mag 7. Yeah.
These companies are not dependent on interest rate cycles like everyone else.
Apple's not sensitive to the quarter point cut in September.
So they are, it's just that simple.
Yeah.
It's just that simple.
So the Qs could be hesitating a little bit here, Mark. There's no doubt about that. But in general, it's one day. But on that one day, I do think the cyclical side and the defensive side was kind of the name of the game on Friday. And we'll see if that has follow through coming into this week. But my anticipation is we will see follow through on that side of the equation. If the NASDAQ wants to lead, it's going to lead after Nvidia. And we're going to know exactly if the NASDAQ wants to lead here after Nvidia, Mark.
Yeah, it's that simple. We'll continue that conversation a little bit. But Matt, as I enter this week, I have a feeling as a trader, I have as much dealer's choice as I've had in a long time, right? Just from a position trading, because swing traders always have a little bit of, dealer's choice, just because what chart setters are given them. But like just from some of those long, maybe from an investing, from a position trading, I have a lot of dealer's choice, right? I have bullish signals in more areas of the market than I've had in a long time.
We have a market. We have a market.
Yeah, we have a
Period
market.
End of sentence. We have a market.
We actually have a market. And once again, we really haven't had a market, man. I would argue
there's good bear stocks out there. There's good bull stocks out there. We got a market. When we have an economic conversation that we're going into, that's a market conversation. That's a stock pickers conversation. That's a sector rotation conversation. That's a macro dream right there. I like these environments.
I like these environments too. I think these are going to be good trading environments, especially for individuals that are looking for cash flow, direction, bearish, bullish. I think, our skill set to these environments is going to work out very, very well. But part of those markets, Matt,
can I just make one comment on your?
Yeah, of course.
There's basically, if you want to find a bullish trade out there, you can find one in many different spaces out there. If you want to find a bearish trade, there are good bearish setups out there. Just on the watch list, every single weekend we curate the traders report, and me and Coach Frank and all the coaches that tackle trading, we put together the best looking technical setups out of the market every single week. And so if you're looking for a watch list of the cleanest technical setups every single week, the scan report, the traders report bull watch list and the traders report bear watch list are ideal candidates. And Mark, when I was going through my broad-based scanning, it's actually getting extremely clean out there, I would say, in terms of the quality of setups out there. And typically when you're scanning in earnings season, you're going to see a little bit more volatility than you otherwise would in non-earnings season. But there's a lot of stocks that we kept off the reports because they were just not as good as others. And again, as you can see, for those of you watching, for those of you listening, on the traders report this week, there were 3 tech plays. There was 1 finance, there's 2 healthcare, 1 staples, 2 discretionary, 2 industrial, 2 materials, 2 energy, and 1 international. That's a very diversified list, and we haven't seen that recently. It's been like 1 or 2 or 3 spaces we're setting up versus some of the others. You're seeing a lot of the market, but again, I do think that is the market has a tendency to do that when you have economic conversations far more than when you have inflationary conversations.
Yeah, absolutely. Will you give me the dollar, Matt? Because in markets, in dealers' choice markets, in traders' environments, I love it when commodities give me the ability to join in. And if I have this chart it doesn't have to continue this descent. In fact, I probably wouldn't want it to continue this descent at this rate, because that might mean things are going really, really bad. But this is ugly look, Matt. This is the type of chart, if this was a stock, we would be like, yeah, you're going to need 2-3 weeks development
it's
before
one of those
you
weird
can.
things where, as a market participant, you want to see downward pressure and price on the dollar, but you don't want to see too much downward
Yeah,
pressure and
yeah.
price on the dollar.
You're like, but talk about the dollar and the impact. Let's go through some commodities.
Dollar's got some concerning information. Number one, the Fed has signaled that they are going to start cutting. That's going to increase the supply of the dollar, and the dollar has to go down in that environment to reflect the increasing supply, especially early on in this phase as the central bank kind of leads this conversation. I know there's been some other central banks around the world that were a little bit early in the cutting cycle. But when the central banks of the United States dollar does it, it kind of forces the conversation out there amongst all central banks in the world. And so initially you should see some downward pressure in price, but that should settle in as other central banks start to have that conversation as well. The concerning part of the dollar is not necessarily what the dollar is doing right now. The concerning part of the dollars is if we start to see further selling and we start to break some really important support levels, because at some point the market will be like, ooh, this is not a good thing. This is a bad thing, because a currency goes at the economic value of that country. And so if you're looking at a decrease here, yeah, everything you're seeing over the last couple of years, that's all interest rate conversations regarding inflation conversations. But now, as we're going into a cutting cycle, not only over the U.S., but around the world, if you start to see the dollar break 100, which is pair against every other currency out there, you got to be a little bit concerned on that side of it, because that's not going to be an interest rate. That's going to be an economic problem if it does violate 100.
Yeah, no. And so interesting chart to follow, especially in tune with economic data as it comes in.
Mark, it's one of those environments where if you lack context on what rate cutting cycles truly do mean, if you lack that historical context, be careful what you wish for in these environments.
Yeah, seriously.
They can get out of control.
Basically, bad news might still be bad news. It's going to be interesting to see.
Again, my take is on the cutting cycles, the historical understanding of what cutting cycles mean. Again, and I think it's very important to say this, and I think it's important for me to say this multiple times over the next, not just this podcast, but over the next few weeks to our community. Cutting cycles are not necessarily bullish. The reason the Fed cuts is extremely important in that conversation.
Yeah, no, and we're going to talk about that 1 second. Let's fire through gold. We got to give gold, silver some love here.
We're going to be talking about gold during the cutting conversation.
All right, let's get into this. Okay, let's get into this historical, because this is going to be a big takeaway from this podcast. What Matt just said. And let me paraphrase, and then Matt can take over some historical data. And Matt and I both led off the podcast talking about like what we're seeing on social media. Money printer go burr. Oh, this is obviously bullish. And how this is a very naive way of looking at it, right? Now, we understand where it comes from. It's a media that's looking for instant headlines.
Well, and people, Mark, when they hear they're getting a cut and interest rates on their credit cards, or interest rates on they're trying to get a home loan, and like, oh, I'm getting a cut. This is really, really good. 100%. If you're in that environment, I'd be like, yes, this is good for us consumers in general. Yes.
But this is obviously also a carryover.
About financial media, who is
a carryover from the 2020-2021 period of the market where social media was dominated by memes and fun times and, accommodative Fed. And, the messaging I saw on message boards was like, hey, we're revisiting those glory days.
No, we're not.
And the message that we're going to deliver right here, and that Matt's going to talk about with the data, is that it's not that this can't be a good time, but it is not that simple. Mm-hmm. It is not that simple. And Matt, you have went through, and you did this on the Tackle Trading newsletter. You went back and looked at the different cutting cycles from the last 45 years, and talk about the data that you found.
Yeah, every week in the newsletter, and if you're not a member of Tackle Trading and you want to become a member of Tackle Trading, the newsletter is obviously one of our flagship reasons why people want to be a part of our community, to get fully apprised of everything that's happening in the market with one newsletter that's going to not only inform you, prepare you, but educate you along the way. And that's what we try to do in the Tackle Trading newsletter. And, every single week, I'm always going to be talking about the technical conversation in our newsletter. There's 3 videos in our newsletter, one on the market, one on sectors, and one on the global markets, meaning commodities, crypto, and whatnot. I'm always writing about the technical analysis in the market, typically writing about earnings. And even though we're not in earnings season, there's always earnings to discuss. This week, I also talked about, obviously, the cutting cycle and what it really means from a historical perspective. So what does history tell us about coming rate cutting cycles? And so I wanted to take a look at how the S&P 500 performs in rate cutting cycles. I wanted to take a look at how gold performs in rate cutting cycles. I wanted to do cross comparison analysis between gold and the market itself, coming to some conclusions, obviously implications for investors and whatnot. And so I thought it was extremely important to make sure that our community is fully apprised of what that all means, with the intimate and important detail that is necessary for our conversations here. I want to make sure that we're just, again, a little bit of the same conversation, but more from a macro, high-level perspective. But definitely become a pro member of Tackle Trading, and definitely check out that newsletter. It's a beast of a newsletter every single week. I'll tell you that. I love putting that thing together. And Mark, you do such a fantastic job writing on the both the global market side of the equation as well as the economic side of the
Love our
equation.
newsletter. Our newsletter is just worth the price.
I would put our newsletter up there against any newsletter put out by Wall Street every single weekend, bar none. And you don't have to pay thousands of dollars for it as well. In fact, you can get it for free right now by signing up for a free trial of tackletrading.com, Tackle Trading in general. Now, cutting cycles. We have had moments where we cut. I wouldn't call it a cutting cycle, Mark. For example, the pandemic. The 2020 pandemic, where we cut from 1.5 down to 0 in a 2-week time frame. I'm not sure I would call that a cutting cycle, since it was 2 weeks and done. But I still think there's importance we can learn in those environments, because those environments happen more now than they did back in the 1980s due to algorithms and how markets participate. But what I looked at, Mark, was the data from 1989 until today, looking at how the market S&P and how gold performs in rate cutting cycles. And what I wanted to understand, because I already know how the market behaves in these environments, what I wanted to understand is basically, what is the causation? What is the reason? What is the rationale in those moments in time when the market did not go down in a cutting cycle? Why didn't it go down? When the times when the market went down in a cutting cycle, why did it go down? I wanted to learn in those environments so that we can kind of have an understanding of what's coming at us a little bit. And so the first cutting cycle was 89 to 92. It was actually June of 89 to September of 92. Second one was July of 95 to January of 96. Third one was obviously the dot-com, 2001 through June of 2003. Then you have the subprime meltdown from September of 07 to December of 08. Remember, cutting cycles typically start before people get concerned about the economy, because the Fed's usually in front of people on the concern regarding an economic conversation. In 2019, we had a fairly aggressive cutting cycle, 0.75 from July of 19 down to October of 19. And then in 2020 was the last cutting cycle we went through, and that was when we went from 175 down to 0. And Mark, what I want to do is I want to take a look at it from a technical perspective and talk about what occurred in those time frames. And so the first time frame I want to talk about very quickly is the time frame in 89 to 92. Now, what happened in 89 to 92 basically was the S&P 500 went up. it actually had a fairly good bullish environment. I think it had price appreciation from right around 315, 320 all the way to up to 413 on the ES. Yeah, we talk about, don't you wish you could go back and buy that breakout of 420 on the S&P mark all the way back in 1989. But it had a good environment. It had a good environment. Gold, on the other hand, in 89 to 1992, in that cutting cycle, gold went down. And so gold had a slight bearish downtrend throughout the years of the cutting cycle in 89 to 92. S&P acted like nothing was going on. Okay, so that's what occurred in 1989 to 1982, that gold slightly down, S&P pretty decent uptrend. And so in 89 to 92, the market continued its bullish uptrend, gold continued to come down. Now, why did they cut in 1989, 1980 through 1992? Why they cut was important, Mark, because they cut. It was at the tail end of the savings and loan crisis from 1987. So the market imploded in 1987, and we were still going through the savings and loan crisis. They cut to alleviate that concern. And so they were not cutting to stave off an economic implosion. And that's very important here. They were cutting to adjust the monetary policy to get more in line with where they were at in the savings and loan crisis. Once again, the reason they cut is going to be extremely important in this conversation. I'm not sure we can take much from the cutting cycle in 89 to 92 because, again, the reason they cut was just to reevaluate the monetary landscape following the disastrous 1987, implosion. Obviously, we had Black Monday in 1987. The savings and loan crisis was all over the place back then, and so I'm not sure we can parse too much because the reason they cut was to simply readjust monetary policy to get better in line with where they wanted it to be instead of cutting because they were concerned about the economy or concerned about inflation. Does that make sense?
Oh, it does. Absolutely.
Okay.
Following along.
So on the first data point, gold down, S&P.
We don't have a similar parallel today to this time period.
No, again, you could, you might. Absolutely. I don't know if that's accurate, Chucky. And the reason I say that is the reason they cut is important. And the reason they cut right now is for what? Why is the Fed going to cut this time? They're cutting
labor.
Okay. But is it labor today?
Okay,
I see labor in the future.
This story is still unfolding.
It's still unfolding. Yes. All right. Now, on the second data point, we have to go to 95 to 96. Now, on the second data point in the S&P, you basically saw the S&P go up pretty decent in the second data point, 95 to 96. Gold also went up very aggressively in 95 to 96. Now, once again, reasons why they cut matter. This, again, was yet another situation where they're just readjusting the policy following a normalization cycle, following a economic event. They start readjusting as they start going into the dot-com market. And so in 91, 92, we had a shallow recession. It's the number one reason why, in my estimation, Bill Clinton became president. So in 91, 92, we have this shallow recession. And you start to see a little bit of negativity coming into the market. In 95, 96, their cutting cycle had nothing to do with the previous recession. Does that make sense? Mm-hmm. It was to readjust the policy to better reflect the environment following a recovery. Again, not exactly the same conversation as today, but in that environment where they're cutting to readjust policy to better reflect the environment, again, being kind of, if you want to go on the dual mandate, being equally sensitive to both the inflationary side of the equation and the labor side of the equation. Gold does good in that environment. The S&P did good in that environment. Okay, so let's move forward. The next data point is where we start to see the modern market start to really take hold here. Because yes, did we have computers, fancy computers? Yes, we did. Of course we did in the 1990s, but not to the level of today. And we certainly didn't have algorithm responses. But in 2001, we start to see how the modern market cycle starts to behave around these interest rate sensitive conversations. In 2000 through 2003, the Fed, going back to our, if we can go back and talk about kind of what they did in that time frame, they went from in January of 01, they had a 6.5 interest rate. They went down to a 1% interest rate. This becomes the modern market cycle, and it's really important to understand this. So in 2001, we start a cutting cycle, okay? What did the market do in that 2001 cutting cycle? Well, the market itself obviously went down very aggressive. And for the first time, we started to see the modern market behave around computers, algorithms, and so on and so forth. Not as aggressive, obviously. Only about 5% of the market was pushed through algorithms, but we still started seeing more computerization back then. Well, Mark, you saw the market cycle go down where economically, you started going down, right? You started going down economically. And then 9/11 happened. And when 9/11 happened, you had another leg down in that conversation. The market did not bottom until they were done cutting. So, once again, in 89, why did they cut? To readjust policy after a recovery. All right. In 95, 96, why did they cut? Once again, to readjust policy after a recovery. In 2001, 2002, why did they start cutting in 2001? Because after the Asian currency crisis of the late 1990s, it was extremely obvious that we were going through some economic challenging conditions. Once the market started going down, they started cutting, and the market continued to go down through the cutting cycle. 9/11 happened. It forced the Fed to cut even more aggressive. The market did not bottom out until the Fed got to the low end of the cycle. And when they made the announcement that this is basically the low end of the cycle, the market started bottoming out there. But this was the first time in the cutting cycle that I looked at where the market did not bottom out before the Fed was done. Does that make sense?
Yep, okay. It sure does.
And so what does gold do in this environment? Well, let's take a look at gold in this environment. Gold goes from 260 up to 360 in that environment. Not only does it go up 33%, it goes up in a very consistent formation during the actual cutting cycle itself. And when the Fed gets done with the cutting cycle, simultaneously what you saw for the first time is the patterns on the top of gold were basically flip it upside down to the patterns that was happening on the market itself. You had a tremendous amount of divergence here that was very, very obvious. But in essence, during the cutting cycle, market down, gold up is basically what it did. All right, let's go to the next cutting cycle. The next cutting cycle was in 07 to 08. Now in 07 to 08, we know that story. Why does the Fed start to cut in 07? They start to cut in 07 because they're getting a little concerned on the economy. We start to see...
We're going bankrupt in lots of places.
We're starting to see the subprime market happen. We're starting to see people get priced out of the market. We're starting to see inflation get a little bit concerning. We're starting to see housing become a concern. We're starting to see zero money down loans for 3-4 years now starting to go foreclosure. We're starting to see 2 million foreclosures. We're starting to see a lot of economic... My point is, we're cutting because of the economy's faltering. That's the reason. And in that scenario, when we were cutting, we didn't stop cutting until December of 2008. In December of 2008, we cut to zero. What did the market do? It bottomed out. Once again, very similar to the 2000 market cycle, the market did not bottom out until the Fed was done cutting. And this time, because the market's like a drug addict and the Fed has to give it more and more, this time they cut to zero interest rate and they announced quantitative easing. Well, that was the end conclusion. What happened in between those time periods, from the time they started cutting to the time they were done, the market went down. I want to say the market went down about 30% from top to trough. It went down a whopping 57% in the S&P 500. Now, was it bad in 07 when they started cutting? No. It created neutrality for about 6 months. 6 months later, not Jay Powell, but Ben Bernanke is giving a speech in front of Congress where he says in February of 2008 that the subprime meltdown is resolved. I'm paraphrasing. We don't have much to worry about. Once again, paraphrasing, but that's what his message was. The automobile sector seems to be recovered. 6 months later, Bear Stearns gone, Lehman Brothers gone, multiple financial institutions gone, General Motors and Ford need bailed out before they go bankrupt. Well, again, why were they cutting? They were cutting because of economic concern. The market didn't bottom out until they were done cutting. Well, what'd gold do? Well, gold went up in that environment. Gold went from 650 to a conclusion right around 850, but it was choppy. But Mark, what happened for the first time after this was the injection of quantitative easing into our world, and gold went from 850 over the next 2 years to 1,800 an ounce in the most parabolic bullish move we've ever seen in the commodity space. And why do I say it like that? Do I think we're round two? I think we're already in the middle of round two, quite frankly. I think we still got more legs to go, but gold was something to be reckoned with in the post cutting cycle market environment. Well, let's move forward a little bit. Mark, what was the next time frame? The next time frame, we got to go all the way to 2019. Now, in 2019...
Yeah, because the Fed didn't like to raise rates very much between those two times.
They didn't do much. For the time they were done cutting in 2010 or 2008, they got done cutting in December of 08. In December of 08. They didn't start cutting again until 2019, 11 years later, because they didn't raise until 2018 due to the trade war. And so in 2019, okay, what do we see? We see the market basically from, let me get the exact dates of the cutting cycle very quickly, if you don't mind, of the 2019. So we went July to October, very quick, July to October. July to October, pretty much flat. Big down, big up, but pretty much flat. Does this V-shaped recovery remind you of anything we've had to deal with over the course of the last... But pretty much flat. A couple V-shaped recovery, but flat nonetheless. What did gold do in that environment? Well, gold in that environment didn't go flat. Gold in that environment went up pretty aggressively, quite frankly, and then went sideways. And then you got the 2020 example, Mark, where it was chaos, it was crazy, it was chaotic. There's no doubt about that. When you look at the S&P 500, the S&P got smoked, 36% down, got absolutely annihilated. But you know what? The pattern didn't change. It didn't change from 2001 on. When the Fed starts a cutting cycle, the market does not bottom until they are done with their cutting cycle. It does not bottom when they announce their cutting cycle. It doesn't bottom when they announce a pivot. It bottoms when they are done cutting, and that basically tells the entire world, if you want a loan, you want to get it right now, because at no point in the next cycle are you going to get a cheaper
and that
price.
particular point is very, very intuitive to me, because it's like, because during cutting cycles, what do a lot of people wait for? They wait for the trough.
They wait for the deal.
And I'm talking about loans, houses,
Everything.
stuff like that. And the second you say that this is probably done, flood of money comes into the system. That flood of money.
Well, think about it from the good debt, bad debt scenario. Investors see debt, good, bad debt. And it's always based on, okay, if I take a loan right now at the Fed fund rate of 5.25, you jack up on a few other interest rates, let's say 8.5%, right? So I take a loan for 8.5%. For me to make that a good debt situation, I have to make more than 8.5% off the money. That's not easy to do, bro. Not when you're the institution of Wall Street and you have to park money in ETFs and whatnot. Well, on the flip side, if you wait for the cutting cycle to be done and now you're getting that loan at 3.5, tack on, say 5%. Well, it's a lot easier to show a gain of 5% on the interest versus 8.5. So it's a good debt, bad debt scenario. But again, it is something we see across the board. But in essence, what the data suggests to me is really what the important part of the data is in 89 to 92, 95 to 96, in 2019, in those three time periods, once again, the 89 example, the 95 example, and the 2019 example, the Fed was not cutting for economic concern. They didn't have their version of Jay Powell get up in front of Jackson Hole and say, we are shifting our mandate to be more concerned with the labor than we are with inflation, the same way Jay Powell did this past Friday. We didn't have those moments. They were cutting for different reasons. And because they were cutting for different reasons, the market was able to do perfectly fine. Gold was perfectly fine. We really didn't see. And what I noticed in my research, Mark, was whatever the prevailing previous trend was the next trend as well, basically. Versus in the moments of time where they cut due to concern on the economy was 0103, was 0708, and was the pandemic. The pandemic's obviously a different beast altogether. But in 01 and 2007, Mark, when they started cutting, the economy was not faltering. When they started cutting, they were seeing data that was concerning to them. Wouldn't you suggest that's kind of what Powell said with the labor this previous week? We're seeing data on labor that's more concerning to us than what we're seeing on inflation.
He used the word unmistakably.
Okay, so Powell has certainly shifted the data hunting, which basically means this. And I know people aren't going to like this answer, but it's the right answer. We don't know what the next direction of the market is. What we know based on the Fed, right? We have our technical reads, we have our fundamental reads, we have our earnings reads, but from the Fed, we don't know. What we do know is similar to 95. Are we in 95 where the Fed is simply cutting to alleviate the inflationary concern and the economy does not falter and it allows the economy to get into a growth mode similar to 96? 95, when they cut, historically, we look at the birth of the dot-com market, Chucky. And so they're cutting right now because they have concern. Does that concern manifest into an economic problem? Or does that concern dissipate like many concerns of the past? We do not know for certain on the S&P 500 if we're going to look back 6 months from now saying this was the start of something bad, i.e. economically, or the economy did not deteriorate. We achieved a soft economic landing, and we were able to achieve a growth story going into 25. That to me is open, which means what now changes? What now changes is this becomes a technical saga. And I love technical sagas. Number one, it becomes a technical saga. Number two, the type of data, when you're looking at Forex Factory, for example, the type of data that's important is going to change a little bit. So, for example, if I'm looking at this week coming at us, right? We got consumer confidence, preliminary GDPs, claims, core PCE report. All right, so we have PCE, which is inflationary based, versus consumer confidence, GDP, and initial claims. Which are more important to you this week?
Well, inflation takes a backseat to them all.
But that wasn't the case last week.
That wasn't the case last month on the similar week.
Exactly. And so I do think the balance, much like the balance of risk shifts to the labor for the Fed, it shifts for us to focusing hyper sensitive.
And Matt, based on your analysis, the very simple, no matter what algos do on any given day, good news is good news and bad news is bad news.
When you go into an economic conversation and the market has an understanding that we are starting the cutting cycle in September, I'm not sure we're going to have a good news is bad news moment, given the fact that the bad news, I find that to be difficult once you go into cutting cycles. Like, because the only good news, bad news is going to be on the pace.
Because you might have bad news in the market rally and the financial headlines say traders make bet of even bigger interest rate cuts.
Now
that doesn't jive. That might be the case that day.
Honestly, bad news on inflation would be disastrous news on what.
Well, bad news on inflation, just bad news. But I'm talking about the other economic data.
Okay, if we see negative labor market prints, I would assume market But initially, the market would be like, ooh, we're going to get a higher interest rate bump.
Initial move up.
No, algos and idiots on Twitter buy that. Pros wait to sell that. That's not a good a good thing.
No, if you see positive economic developments, that's good news.
That's fantastic.
That's fantastic news.
Because again,
it's not just good news, it's fantastic news.
No, it's fantastic news because it's important to understand. In cutting cycles, the last 6, okay, some a little bit quicker than others, but in the last 6 cutting cycles, the market has went up in 3 of them. The market has went down in 3 of them. But the average is skewed to down because the times the market went up,
because when they were missed,
when they missed, they got beat pretty hard, right?
Yeah.
We're talking about 3 of the biggest market sell-offs in history when they miss. So it is skewed to the negative in my estimation on the S&P 500. And that's what you're seeing on this graph here is you're seeing the market performance in those years of the cutting cycles. And again, you got 3 green, you got 3 red. That's a 50-50 crapshoot because it goes to what the economy does next, Mark. In 2001, when they announced the cutting cycle, they didn't know the economy was going to start imploding in 01 and 02. They certainly didn't know 9/11 was going to happen a year later. In 07, 08, in July 07, Mark, I'm sorry, we're not in a recession in July of 07. The market's bullish, the economy's bullish, but they start their cutting cycle because they started shifting the balance. Well, what occurred? It took about 6 months for the market to turn over, but when it did, it turned over hard, which meant the economic reports like labor, manufacturing, retail sales become very important. On gold, however, Mark, gold tells a very consistent story.
And I'll be honest, I told Matt this because when I went to read the newsletter as a consumer, and I was reading through the newsletter, I got to this chart and I was like, oh, behave yourself, gold. Behave yourself.
Behave yourself. I like it. But it does. It does behave itself very well. It has a very consistent history. And Mark, how many times have you heard me say this over the years? Just wait till the pivot. Like gold has a historical edge, tremendous historical edge, quite frankly. Consistency across the board. The 189 to 92 cycle basically flatlined throughout those years. 95 to 96 had a big momentum bid on that one. 01 to 03, obviously, we saw gold go up. 2007 to 8 saw a 22% rise. 19 saw a quick rise on gold. 2020, we saw what happened with gold. Gold from 1995 on bets 100% in pivot cycles, 100% in rate cutting cycles. 89, 92, take that into equation. We're talking about 5 out of the last 6 gold. And when you're talking about the consistency, Mark, it's consistent.
Yeah, I mean, there's just
so you look at, and then when you look at it in general, Mark, the graph we're looking at now is S&P versus gold in those same cutting cycles. And I just think gold has an edge. It obviously has an edge here. Now, has some of this been priced into gold? Of course it has. Has all of it? Not in any capacity, Mark. Not in any capacity. And when you are looking at gold, you're talking about the number one protection asset class in the world, number one, that will protect you against inflation or the economy. And you're talking about that just breaking out of a multiple time frame level just 2.5, 3 weeks ago. This thing looks primed, Mark. And again, my open question on gold is how much of what I'm talking about is already priced in. I'm not even sure that matters to me on gold because there's so many different variables of why people would own gold these days. I look at GDX here, Mark, and I look at GDX on a monthly chart, for example. And you're not talking about an all-time high price on gold. You're talking about a very important number at 40 that once GDX gets above 40, I'm not sure it stops till it gets to 50. And I'm not sure we're not going to be talking about 60 in a year from now. And so I just think gold itself stands out. Regardless of the economic data that occurs over the next 6 months, I think gold stands out. For the market itself, my research and my data suggests very clearly that there is not an edge in cutting cycles when it comes to the S&P 500 itself. It is a 50-50 crapshoot with the risk skewed to the downside. And anybody who says anything other than that is lying for visibility reasons and likes on Twitter, and it's absolutely ridiculous. The data is 50-50, and it's skewed to the risk to the downside in cutting cycles. But the reason the Fed cuts is important. The Fed has told us they're cutting for what reason, Mark? Labor. That's what they're concerned on the labor side. Well, if the labor side doesn't implode and they're confident on their path to 2%, this market doesn't have to be 2001 through 2003 or 2007 through 2008 or 2009. It doesn't have to be the pandemic. It can be 95 through 96, Mark. 1,000%. This moment in time can absolutely be 95 through 96 if the economy does not continue to go down, and the policies coming out of the next administration, quite frankly, are legitimate economic policies. But that is a different conversation for another podcast. For now, I love gold. I do think we're going to go through a little bit of a commodity cycle here. Typically, I didn't do silver or the other commodities out there, but I would say I know my silver, it goes in line with gold, just at a different pace and a different starting point. But I would assume the rest of the commodity space looks fairly similar to that of gold in these environments.
And obviously, we are going to track the economic development, which is going to be very important. A combination of technical analysis and good old-fashioned following where the data takes us on the economy. We're going to have plenty of data points. We're going to follow them all. Follow us on Tackle Today on our Tackle Trading YouTube channel or with our Pro membership, where we do an in-depth job of that. Matt, Nvidia, this week, all of this big picture stuff, and then all of a sudden this company that has been the focal point of the last 18 months of price action has earnings this week. Now, I'm going to throw out a couple outlandish statements, all right? And I want one, Nvidia does not matter for your average stock this week. How do you feel about that?
Disagree with that on this week, but I would agree with that on the next 3 months.
You get the sentiment though, like
Nvidia's too big. It'll impact everything.
So it's too big for the index itself.
It's too big for the algorithms to not have an impact on the other stocks in the market.
Outlandish.
That's like saying that Titanic going down, nobody would notice it.
Okay, fair enough.
Now, but again, I think that's an algorithm response in the immediacy. I do not think trending analysis would occur here. I think that Nvidia specifically would help create trending analysis in the NASDAQ and aggressive sectors. But Nvidia's guidance report and whether or not we get way excited about Nvidia's guidance report isn't going to have anything to do with McDonald's.
Yeah. Outlandish question number 2, and then feel free to build off any analysis from there. Nvidia has provided a triple, just the hat trick, just smashed 6 straight quarters, right? Like, it doesn't matter. They beat. Is the bar getting so high now that even a fantastic report gets sold?
No. This is a 10-year saga on Nvidia. I would say the bar's high for the current moment in time, given what ASML reported on earlier in the season when they when they basically dropped their guidance and made us all concerned on the AI front. But I would say no.
Okay, so what are you looking for, Matt? Because these things have been stellar.
I'm looking for them to increase guidance and start a trend in technology and have technology lead the next cycle up with everything.
So technology leads, but unlike the last 18 months where it has been a tech only, except for a couple
markets
pockets.
in the history of mankind are always tech-driven markets.
We really have not. We had a couple months coming off the Powell pivot in November, even unofficial, but the change in tone, right? But really for 18 months, Matt, we haven't had a market. We've had
you want to talk
first
about a
moments.
Goldilocks scenario? That's what you want. You want a Goldilocks scenario?
I want to know.
Goldilocks scenario is a hat trick out of Nvidia and a miss on the labor market next week, a week and a half from now.
but not too big a miss.
Listen, a miss is miss here.
But but still growth, right?
Yeah. Well, okay. Well, I meant a miss on the. Okay, let me rephrase. The best 1-2 punch.
Okay, give me this Goldilocks.
An Nvidia increase in guidance for the 7th consecutive time, which would throw a bunch of cold water on that slowing growth argument.
Yes, it would.
The difference between ASML and what they set off versus what the linchpin of all of this does, two vastly different conversations there. So NVIDIA has the chance to wipe away the slowing growth concern in the AI space. And the AI space is all Mag 7, all technology, all semiconductor, half of software components right now. Like it's a big conversation in the AI space right now. NVIDIA would wipe a good beat of NVIDIA, and I expect NVIDIA to beat against expectation. Guidance is the question, and guidance is important. But if NVIDIA does pull off the hat trick here, and I do think that's what tech is waiting on. I do. You could see a tech breakout, and you could see a relative outperformance on tech in that scenario. Absolutely.
It would be nice to have a market again. Like it really would. Like I'm tired of trading indexes because that's where the safety's been, right?
Well,
like,
it's also been earnings season, and right after we started getting, think about it, Mark. We had earnings season, then we had the central bank, then we had Jackson Hole. We've had chaos in between. It's been a month. History books are going to write about this month we just went through. Both geopolitically with what's happening in the Middle East right now, the election. Wow, just you want to talk about history books writing history being made? The last month has been absolutely off the charts. It's been a crazy time. It's been a crazy time. I'm not saying it's not going to be crazy for the next 3 months. It will be, but I do think it's simmered down here from a technical perspective. We have went through, imploding down, V-shape up. Now I think ultimately the question is a technical one. The technical question is probably going to go at the economic conversation. So I think the number one thing we're going to be tracking, especially post NVIDIA, is just pure technical analysis. And those are markets I actually enjoy. I think those are good markets.
And we haven't really had a chance to talk about, because one of the things you and I do really well, and we do well at Tackle Trading, is spotting the overperforming, underperforming. There's been too much volatility over the last month to really establish any trends or notice any little small edges, right?
Would you say the only edge going into this week is cyclical and defensive right now? Like that's kind of where my head is at with the RSP breakout. When RSP leads SPY, that's cyclical and defensive is what that's showing. It is. And so don't you just think it's really kind of as simple as that, where early in the week we're looking cyclical and defensive, later on the week, depending on what NVIDIA does, we might have a tech conversation or not?
Yeah, no, I mean, I think there's still a lot of variables. I mean, the RSP chart to me says, and I look at these a little different. When I see that RSP chart, I'm like, oh, wow, bottom and mid-tier breakouts are freaking fantastic because you're having broad participation. And when you have broad participation, technical setups have a lot of, no matter where they're occurring, and sometimes those lower and mid-tier can provide you the best right? Right, because GE might just keep trugging along, right? It might just keep trugging along. Things that have done well already, right? Well, they might keep just trugging along, right? But give me two give me two breakouts of equal moves, right? I guess is what I'd rather take a mid-tier equal out if I have to only choose one, right? But RSP to me says I got a lot of choice. I got choice all over the board.
I think the market is broadening out far more than what I think a lot of people understand right now. And by the way, I think the cutting cycle and all the conversation we had just leads to two conclusions. Number one, buy gold. I think that's the first conclusion that cutting cycles come to. Number two, the path of the market is going to be dependent on economic data that comes in. I think that's very, very clear right now. And so I think there's a little bit of an open question on that side of the equation. But regarding specifically tech versus the other areas of the market right now, I have a hard time having an opinion on semiconductors when NVIDIA's earnings report is in 4 years from now.
I mean, tech actually, Matt, I was looking at some fun statistics, just my final thought on the matter. Like funds are underweight tech by the most they've been in years and years and years and years, right? Kind of calling their shot that the tech runs over. It's time for other.
Even though tech and everything's kind of been doing the same thing. I mean, Mark, in general, we've been talking about neutral markets for the last little bit. V-shape up, V-shape down, whatnot, but we haven't seen massive breakouts. I think NVIDIA's either going to start something or we're going to continue to talk about tech the same way we have. If NVIDIA starts something here, I think we all need to be looking at tech, like every single one, because you don't want to miss out on an NVIDIA-led tech run. You do not want to miss out on that. I don't care anything I said about the cutting cycle today. I don't care about anything I said about anything else. If NVIDIA beats earnings, which is almost a given, they're, I think right now, top range guidance was $28 billion on revenue. I think they're right now expecting like 28.8 right now. Mm-hmm. So we're going to get beats on EPS. No doubt. I have no doubt about that. Even with the high bar on NVIDIA. It's always going to go to the guidance and what NVIDIA is saying about guidance in the future. If we get a guidance update and all of a sudden we're talking about quarter to quarter finally breaking out here on NVIDIA, I mean, I know it's choppy, but Mark, quarter to quarter, we really haven't done much on NVIDIA. Here's NVIDIA last quarter. This is where the gap up started, was 107. It's been neutral ever since then. Yeah, we're up towards the top, but we haven't seen a breakout. I'm sorry, if NVIDIA wants to lead a tech run, I'm here for it, but it's only going to happen based on increase in guidance. And so I think early in the week it's cyclical and defensive. Later in the week it could be tech.
Yeah, no, I enjoyed this conversation. I love treks through history, and this is an important one, right? And it is going to help formulate my own personal trading. Economic data is going to matter because they'll form narratives, and those narratives will feed into these type of conversations.
Specifically, PMI manufacturing numbers, GDP numbers, and labor market numbers.
Yeah, and so inflation takes a back seat for probably several months until something changes the conversation.
Until that first hot CPI report.
Until something changes the conversation. Well, Matt, listen, I've enjoyed this, and we every day on Tackle Today and continuations into the lounge go over the economic data from that day. It is something we do every day on Tackle Today. You can go to the Tackle Trading YouTube, watch the playlist. We do it every day. This will be an evolving story. This will be a story by the day. We'll track it. We'll continue the conversation. And then, of course, recap it on the Trading Justice podcast every weekend. But, Matt, give us some final thoughts. Close us out.
Yeah, once again, I love historical data. And I love it when it brings to a proper conclusion of how you should behave. Was it Isaac? Who was it? Was it Einstein who said history doesn't repeat, but there's a rhythm to it? Or was that who was that? I can't remember off the top of my head. I'm not sure history is going to repeat specifically on gold analysis going into the cutting cycle or the S&P. What I do know is that gold has an edge in cutting cycles. And gold has an edge. We saw it historically through the price action. We saw it through the consistency. It has an edge through cutting cycles. And I don't think it's a close conversation, quite frankly. The path the market takes is gonna go at the path the economy takes. And that might seem like, oh, nice hot take, Matt. If you listen to the Trading Justice podcast over the last 13 years or 11 years I've been doing this. We're on episode 593 right now. If you've been listening to the podcast, that is a massively hot take out of me because the market typically doesn't go at just a one-to-one to what the economy does. It's far more nuanced than that. But that's when the Fed is focusing on, one aspect of monetary policy versus the other. I think in the S&P, it's going to go at the path of the economy, which means I would expect good news is good news, bad news is bad news from an economic perspective. And that is not always the case in the markets. And so those economic reports are going to be a little bit more sensitive to algorithm responses and obviously, market participants in general. Every single day, we're going to put out the Tackle Today email, which you can, go subscribe to for free at Tackle Trading and get, 10, 15-minute video to kind of recap what's going on in the market that day. Obviously, a nice little write-up to help you understand the information that's coming in the market that day. But if you want something more extensive, more expansive, and a little bit of a deeper understanding, come over to the Pro membership of Tackle Trading. Start familiarizing yourself with the Tackle Trading newsletter, which basically lays out all of our analysis on a week in, week out basis, including not only all those write-ups and all those videos, but we rank every sector, we rank every commodity, we make sure that you're fully apprised. Tackle Trading is a one-stop shop, ladies and gentlemen. We want you to get your knowledge from Tackle, trade the Tackle systems, understand Tackle Trading's investment philosophy, how we like to help you out as well, but also get your news from Tackle Trading. There's so much nonsense out there. There's so much nonsense. Every single day we break down the news of the day, the stocks of the day, the economic reports, so that you can get your news from a trusted source, and that's what Tackle Trading is for the financial markets and specifically our Tackle Trading community. So you want to be a part of that? It's real simple. A lot of different ways to do it, but if you want to become a Pro member of Tackle Trading, you can go over to tackletrain.com, get access to everything in the Pro membership with a 15-day free trial. And with that said, I hope everybody has a wonderful, wonderful rest of their day. And let us know if you need anything from Tackle Trading.
Have a great
Recording
week, everyone.
stopped.